Some more macroeconomic concepts. Net indirect tax, NIT. Net indirect tax refers to the difference between indirect taxes and subsidies. Indirect tax. Indirect taxes are the taxes imposed on the production and sales of goods and services by the government of a country. For example, GST or goods and services tax. Indirect tax imposed on a good or services results in increase in its price in the market. For example, if the cost of production of a good is rupees 1000 and the government levies 10% GST on it, then the good will be sold as rupees 1100 in the market. Some more macroeconomic concepts. Subsidies. Subsidies are the economic assistance given to firms and households by the government with the aim of the general welfare. It is also known as financial assistance. For example, LPG cylinder in India is sold at a less rate or subsidized rate. The government usually grants subsidies to promote exports or to encourage organizations to set up industries in the backward regions. Subsidies are not like indirect taxes, they reduce the market price of a good or service. For example, if the government grants rupees 20 subsidy on the above mentioned good, it will be sold at rupees 1080 in the market. So the formula net indirect tax is equal to indirect taxes minus subsidies, or net indirect tax is equal to factor cost plus indirect taxes minus subsidies. Factor cost versus market price. Factor cost is the amount paid to the factors of production for the factor services provided by them in the production process. In the above example, rupees 1000 is the factor cost, whereas market price is the price at which the product is actually sold in the market to the consumers. The market price of a good or service includes indirect taxes and excludes subsidies. In the given example, the market price of a good is rupees 1080. So market price is equal to factor cost plus net indirect taxes. Net factor income from abroad, NFIA. It refers to the difference between factor income received from the rest of the world and factor income paid to the rest of the world. NFIA is equal to factor income earned from abroad minus factor income paid abroad. Factor income from abroad is income earned by the normal residents of a country from rest of the world in the form of wages and salaries, rent, interest, dividend, and retained earnings. Factor income to abroad is the factor income paid to the normal residents of other countries, that is non-residents, for their factor services within the economic territory. Significance of NFIA. NFIA is significant to differentiate between domestic income and national income. In practical estimates, domestic income is estimated first and then national income is derived in the following manner. National income is equal to domestic income plus factor income from abroad minus factor income to abroad. The difference of factor income from abroad and the factor income to abroad is termed as net factor income abroad, or NFIA. Normal residents, any individual or an institution who ordinarily resides in a country and whose center of economic interest lies in that country is the normal resident of that country. The center of economic interest includes two things. First, the residents of a country lives or located within the domestic territory. Second, from that location, these residents carry out basic economic activities of earning, spending, and accumulation.